Unrealized gains versus realized losses. Let's face it, investing is as much an emotional roller coaster as it is a numbers game. If you've ever logged into your brokerage account and seen your portfolio riding high, you've felt the thrill of unrealized gains. But if you've ever had to sell a stock at a loss, the sting of realized losses can feel personal. Before we dive into the emotional, financial, and strategic impacts, let's clear the fog with a basic definition of both unrealized gains and realized losses. Unrealized gains are profits that exist, on paper, but haven't been locked in by a sale. Say you bought Apple stock at $100 and it's now trading at $160. That $60 per share increase is an unrealized gain. You're richer, but only if you sell. An unrealized gain is like finding treasure on a map. You know it's there, but you haven't dug it up yet. Holding onto these gains makes sense, until the market takes a turn. If the price drops to $120, you still have a gain, but it's a lot less impressive now. And if it dips below your purchase price? Welcome to unrealized loss territory. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 25% off your next purchase. A realized loss happens when you sell an asset for less than what you paid for it. It becomes part of your actual financial statement, not just your portfolio dashboard. Example: bought Tesla at $250, sold it at $190? That $60 per share loss is now realized and it hurts. But not all is doom and gloom. Realized losses come with a silver lining: tax benefits. Unrealized gains happen while you still hold the asset. Realized losses occur when you sell. One is potential, the other is permanent. While these gains aren't taxable yet, they still contribute to your net worth. They also impact asset allocation. If one stock balloons in value, it could throw off your portfolio's balance. Time to rebalance, maybe? Here's where it gets good. Unrealized gains are not taxed. That means you can let your investments grow without paying Uncle Sam yet. But beware. Once you sell, the IRS wants its cut, especially if it's a short-term gain, held less than a year. Your brokerage shows unrealized gains in your portfolio value. Realized losses show up in your transaction history and on your taxes. You'll report these on Schedule D of your IRS tax return. Brokerages typically provide 1099-B forms, which summarize your capital gains and losses. Just plug and play, or better yet, hand it to your accountant. Fear of missing out, also known as FOMO, and greed often cloud judgment. Holding onto a winner feels good, like watching your fantasy football team crush it on game day. But overconfidence can turn those paper gains into missed opportunities if the market reverses. When people tend to sell winning investments too early and hold onto losers too long, hoping they'll bounce back, this is known as the disposition effect. Selling at a loss feels like failure. It's emotional. It's final. Investors don't want to admit they were wrong. This is known as loss aversion. We feel the pain of losses twice as much as the pleasure of gains. Investing is not about being right. It's about being less wrong over time. Holding onto a losing stock is like staying in a bad relationship because you've already invested too much time. You hope it gets better, but deep down, you know it's time to let go. There's no shame in taking profits. In fact, many savvy investors use the trim and trail approach. Trim a portion of your winning position to lock in some profit. Let the rest trail with a stop loss or a defined exit plan. This protects your downside while leaving room for more upside. Ask yourself, has the investment hit your target price? Are there better opportunities elsewhere? Has the company's outlook changed? If yes, it might be time to ring the register. Cutting losses is like ripping off a band-aid. It stings, but it helps you heal. A few reasons to sell. Fundamentals have deteriorated. The thesis for buying the asset is no longer valid. You need to rebalance your portfolio. You're using the loss for tax harvesting. Don't forget, losses are part of the game. Even legends like Warren Buffett and Ray Dalio have taken hits. Conclusion. The difference between unrealized gains and realized losses isn't just accounting jargon, it's a window into your investment performance, tax planning, and financial decision-making. Knowing when to sell, when to hold, and how to use each to your advantage can make a major impact on your wealth over time. In the end, investing isn't just about math, it's about mindset. If you can detach emotionally and think strategically, you'll be far better positioned to navigate the volatile waters of the market. So ask yourself, are you holding for hope, or holding with a plan? If you're unsure where to start or need help optimizing your portfolio for gains and losses, consider consulting a financial advisor or using smart portfolio management tools. Because in the market, knowledge isn't just power, it's profit. Thank you for watching.